Hello and welcome to our latest MiViews update. I'm joined today by Salman Baig from the Cross-Asset Solutions team as he shares the team's outlook for the coming months. So Salman, as we enter the second half of this year, how does it compare with the first half?
Well, so in terms of key macro drivers, global growth, which had slowed down and desynchronized during the first half of the year, is now showing signs of stabilization and even a rebound. This is especially true in the United States, but more broadly in developed and emerging markets. It's still early though, so we're watching that closely. In terms of inflation risk and market stress, we view those both as being high for the second half as they were for the first half of the year. One of the important differences, though, is monetary policy uncertainty, which was a key risk for us during the first half of the year, has largely receded. The Fed, during their June meeting, made clear that they will follow their monetary policy path tightening. It'll be gradual, and we don't see any risk of derailment there. The ECB, on the other hand, has made very clear that they will maintain a dovish stance for the rest of the year. And then finally, one of the important new sources of uncertainty is the US-led trade war. We started some of that in the second quarter of this year, and we expect that to continue for most of this second half of the year.
And what are the key themes that are likely to shape the next coming months?
So in our view, one of the key themes for the rest of the year will be whether the rebound we're seeing in global growth is a temporary phenomenon or a real recovery from the slowdown that we saw in the first half of the year. The other key theme is the uncertainty introduced by the US-led trade war. So far, the impact on the real economy is minor, but de-escalation does not look likely in the next few months. And while the situation is volatile, obviously, downside risks only seem to have increased over the last few weeks. And the last theme that we think will be key for the rest of the year are tensions in emerging markets. So we've seen over the last few months emerging market currencies and equities selling off. And when we look at emerging market corporates, we see large debts denominated in US dollars, meaning they've left themselves vulnerable to a stronger dollar rally and any contraction in demand that would occur in the ensuing monetary policy tightening. When you layer on top of that the trade war concerns, it paints a picture of emerging markets that's fairly tenuous.
And finally, how does this inform investment decisions and portfolio positioning?
Looking at the fundamentals, global growth is still above potential and showing signs of a rebound. Monetary policy remains fairly accommodative. We are still believers in the growth story and view equities as an attractive asset class, especially in light of valuation metrics having receded over the last few months. Nonetheless, we're still wary of inflation surprising to the upside and maintain positioning that would benefit if that happens. So for example, an overweight in break-even inflation. At the same time, we can't ignore the risks that are out there. So when it comes to, for example, emerging market equities, we have a fairly neutral stance. In emerging market FX, we are looking for attractive risk-reward opportunities versus the US dollar. And finally, when it comes to hedging trade war risk, we think the best way to do that is through one, diversification, and two, dynamic risk management via, for example, options. We don't think it's a good idea to reduce exposure to growth-oriented assets like equities, since the fundamentals there are still quite positive.
For further information, please visit our website at www.unigestion.com.